The CBOE Volatility Index has a long-term average level of about 19. Well, so far this year, the VIX hasn't reached 19 once. In fact, hasn't really come close at all. How long can volatility stay this low? This is one of the great mysteries of the market. Max Wolf, Dennis Davitt, your Trading Nation team. Dennis, I mean, this is right up your wheelhouse.
Yep.
I understand that the market has been chugging along, going higher every day, so I can make the argument for a low VIX. But with everything else going on, North Korea, et cetera, I'm not sure I could make the case for a 9 to 10 VIX. What the heck is going on?
Well, a 9 to 10 VIX, I think, is justified in the market. Right now, everyone's focusing on Korea and other macro risks that may be in the marketplace, but no one's focusing on what's going right. And I think people need to step back and take a look at what's going right in the marketplace. One of the things that really drives low VIX are products that sell volatility. And very popular products now are yielding products. So there's probably $100 billion of assets dedicated to strategies that sell volatility into the marketplace. And the way I can kind of simplify this is who has the strong hand and who has the weak hand at the table. In the past, people who were short volatility had the weak hand because they were short volatility on leverage. So if volatility went higher, they had to scramble to cover volatility. Nowadays, the people who are long volatility tend to be long volatility on leverage. And because of Dodd-Frank and a lot of the rules that we have in place, the short volatility players are not as leveraged. So there's more people selling volatility, but they're better capitalized with their volatility sales.
Okay, Dennis, before we go to Max, I want to follow up with this. I understand the VIX and volatility have become partly their own market. That's partly what you guys do at Harvest Volatility Management. So does that mean that the VIX, though, is no longer relevant to just the mom and pop equity investor? Sounds like volatility has become its own thing. Does it mean anything for the broader market then?
I do think that we are in a market that is much more based on structure, market structure, than fundamentals. So using the VIX as an indicator whether or not to buy the market, I would say is broken. Yeah, I would agree with that statement because people are using it for other sorts of things. And those other sorts of things are adding stability to the market, causing the market to move less, causing the VIX to go lower, causing those strategies to be more successful, so it synergistically builds on itself.
It's kind of become its own thing in a way. Max Wolf, how much are you using the VIX as a macro tell, if at all?
Right, so I think the VIX gives us a really good idea about what the attitude about risk is on some level, but I would have to echo part of what we've just heard there. And the point being that the VIX has become a speculative object. It's become a way to make money betting against volatility, which is something that's been very much rewarded in the market. And so you have a big momentum trade betting against that volatility. And so what's sort of happened is this thing we try to use as an indicator, the VIX, has become the object of a speculative game, and that's pushed it down, which if you really sort of boil all the jargon and the structure off, what it means is that it's probably somewhere between a counterintuitive factor and a pretty weak factor in telling us what the actual riskiness of the market is. Because what's happened here is our perception is anything external to the pricing action of a small number of much loved momentum-driven shares is totally irrelevant. And folks who made that bet, right or wrong, have made money. And folks who bet against that, some folks who listen to me and bet against it, have lost money, right or wrong, in the bigger picture. And so we have a whole lot of momentum pushing against this particular indicator. That being said, I still think we are in a fight now with our second and third largest trading partner. Our relationship with our first largest trading partner, China, is a little bit rocky. We're closer to some sort of problem on the Korean Peninsula than we've probably been in 70 years. And I'm not sure the world looks as passive as that indicator suggests it does. But I do agree that there's a good reason for why it's low. And I don't see that reason unwinding in the immediate short term.
Max, Dennis, you want to follow up on that?
Yeah, and I agree with what Max is saying. And if these are concerns of yours, the VIX is a good indicator to tell you that there's an opportunity to insure your portfolio at a really low price. So, is insurance expensive on your portfolio? It's inexpensive now. Does that predict where the market's going? No. But if you're concerned, then you should go buy some puts because they've never been cheaper.
Good discussion on really what is arguably one of the biggest questions out there we get all the time about volatility. I think the VIX and volatility, to your point, Dennis, maybe is moving away into its own market, creating its own opportunities. We'll see what it means for the overall market, though. Max and Dennis, thank you both very much. And folks, as always, thank you for tuning in. I'm Brian Sullivan. We'll see you next time.